Welcome back, everybody. Don't forget to hit that subscribe button and give us a like if you're enjoying this show. Today, we're going beyond those big tech companies to find some investment opportunities you might be missing.
You know, it's crazy how much those Magnificent Seven have impacted the market rally. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, they're everywhere right now.
Yeah, totally. They're all over the news. But what about all those other companies in the S&P 500?
Right, exactly. That's what some are calling the S&P 493, everyone else who's not in the Magnificent Seven. And a lot of them are actually using things like AI and automation to really boost their profits.
So while everyone's looking at big tech, there might be a lot of value hidden in those other companies. But aren't those big tech companies trading at super high valuations? Can they really keep growing?
Well, yeah, their price-to-earnings ratio is almost 30, which is definitely high. But a lot of analysts say those valuations make sense because their profit margins are so strong. So the question is whether their earnings will stay high enough to justify those prices.
Makes sense. I mean, high valuations are fine if the growth is there to support it. What about the S&P 493? How do their valuations compare to the Magnificent Seven?
The S&P 493 is currently at about 20 times forward earnings. That means there's probably room for growth there, which makes them a more attractive option for some investors.
So it sounds like there's a lot of potential in the S&P 493, especially if they can keep using technology to improve their margins.
Yeah.
What about mid-cap stocks? Are they worth considering?
Yeah, mid-caps are definitely gaining some momentum. Analysts are predicting they'll see good earnings growth, like 13.7% in 2025, and then even more in 2026.
Wow, almost 16.5%. That's a pretty big jump.
Yeah.
I thought they were having a tough time last year with all the interest rate hikes and economic uncertainty.
They were, but there's a lot of optimism now that interest rates are stabilizing and the economy is becoming more predictable.
So we've got the potential for value in the S&P 493, and mid-cap seem to be doing well. Where else should we be looking beyond those big tech giants?
Well, value stocks are always an interesting category, especially in sectors like financials, industrials, and even some consumer discretionary and IT companies.
Weren't financials doing really well at the end of last year?
Yeah, their earnings were great in Q4, way above estimates. It was their best performance since 2021.
That's pretty impressive. But with value stocks, you have to be careful about those value traps, right? Just because a stock seems cheap doesn't mean it's a good investment.
You're right. Some of those small cap companies that look cheap might actually have weak cash flows or a lot of debt. We have to be really selective.
So doing your research is key. We've been focused on the U.S. market, but what about international markets? Are there any opportunities there?
International markets are looking good to some investors right now. The MSCI World ex-US Index is trading below 14 times forward earnings.
So does that mean international markets are undervalued compared to the U.S.?
Maybe, but a lot of experts are actually suggesting investors stay home and focus on U.S. stocks instead of diversifying internationally. It's a pretty interesting debate.
So there are two different perspectives on international investments. What's driving this stay-home view?
Well, there are a few things. The U.S. dollar is strong right now. There are concerns about geopolitical risks in certain regions, and some people think U.S. companies are better equipped to handle economic uncertainty. But people who like international diversification say it reduces risk and can lead to better returns because you're invested in different economies and industries.
It sounds like diversification is important regardless of whether you're focusing on U.S. or international markets.
Exactly. If you spread your investments across different sectors and types of assets, you can handle market ups and downs better and reach your financial goals over the long term. It's about finding the right balance.
It's not just about picking individual stocks, it's about making smart decisions and looking at the big picture.
Exactly. And that's where a strategic approach comes in. You need to know your financial goals, how much risk you're comfortable with, and then develop a plan that works for you.
So it sounds like we need to be thoughtful about our investments. We can't just follow the crowd or the latest trends.
You're absolutely right. Investing is a journey, not a race. It's about making informed choices, staying disciplined, and being patient.
Well said. As we look at these different opportunities beyond the Magnificent Seven, let's keep those principles in mind. It's all about finding value, managing risk, and making smart choices for the long term.
Exactly. And remember, investing is always changing. New trends come and go, markets fluctuate, and unexpected events can happen. You have to stay informed, be ready to adapt, and never stop learning.
So stay tuned as we continue to explore. We'll be looking at specific sectors and companies that are worth a closer look and giving you insights and tools to make informed decisions.
And as always, feel free to share your thoughts, ask questions, and join the conversation. Your insights are valuable, and we're all in this together.
So we were just talking about how important research is when it comes to evaluating investments. It's easy to get caught up in the hype, but we got to make sure we're looking at the facts and not letting our emotions drive our decisions.
Definitely. It's all about filtering out the noise. There's just so much information out there, but focusing on the fundamentals is key. We got to invest in companies with a solid foundation for growth.
Makes sense. And speaking of growth, we talked a little bit about mid-caps earlier, and analysts seem pretty bullish on them. What's making them so optimistic?
Well, mid-caps tend to focus more on the domestic market, which can be a good thing when the global economy is a bit shaky. They're also in a sweet spot, big enough to have established businesses and strong management teams, but still agile enough to adapt to changes and jump on new opportunities.
So they can grow without being bogged down by bureaucracy like some of those massive companies.
Exactly. And they're not as affected by the volatility of international markets. A lot of mid-caps are really tied to the U.S. economy, which is still a major force for innovation and growth.
That's a good point. And like we mentioned before, analysts are predicting some strong earnings growth for mid-caps over the next few years. Do you think that's realistic?
I think it's definitely possible. Of course, a lot depends on things like interest rates, inflation, and consumer spending. But a lot of mid-caps are in a good position to benefit from the economic recovery. They're often in sectors that are essential to the economy, like healthcare, tech, and consumer staples.
So it's not just a temporary boost. They're in sectors with long-term growth potential.
Right. And a lot of these mid-caps are investing heavily in research and development that could lead to new products and innovations that drive growth even further.
That's exciting to hear. It seems like mid-caps offer a really good balance of growth potential and stability. But like with any investment, there are risks involved, right?
Of course. Nothing is completely risk-free. Mid-caps can be a bit more volatile than large-cap stocks, and they can be more vulnerable during economic downturns. You really need to do your research on individual companies and consider the overall market conditions before making any decisions.
So due diligence is key, as always. We've talked about the S&P 493 and mid-caps. Now, what about value stocks? What role do they play in all of this?
Value stocks can be a good option for investors who are looking for companies that are undervalued by the market. These are usually companies with strong fundamentals, but they might be overlooked for one reason or another.
Kind of like hidden gems waiting to be discovered.
Yeah, you could say that. The trick is figuring out which companies have the potential to turn things around and reach their true value. It takes a lot of research and analysis, and you got to be patient and wait for the market to catch up.
So it's not about quick profits. It's about investing in companies with a solid long-term outlook.
Exactly. Value investing is about finding companies that are trading below their intrinsic value. It's a long game that requires discipline and going against the grain sometimes.
You mentioned that value stocks are often found in cyclical sectors. Can you explain what that means?
Sure. Cyclical sectors are those that perform well when the economy is strong and struggle when it weakens. These include industries like financials, industrials, consumer discretionary, and energy.
So they do well during booms, but take a hit during slowdowns.
That's the general idea. But remember, not all companies in a cyclical sector will perform the same way. Some companies are better managed than others, and some have a stronger position in the market. Do your homework and choose companies that can handle those economic ups and downs.
Yep, that makes sense. It's not just about picking the right sector, but the right companies within that sector.
Exactly. And that's where the real skill of value investing comes in. It's about finding those companies that can outperform even when their sector is facing challenges.
So we've got the S&P 493 with its focus on cost-saving tech, mid-caps with their potential for growth and stability, and value stocks for those long-term gains. Are there any other areas worth exploring beyond the Magnificent Seven?
We've mostly talked about the U.S. market so far, but we shouldn't forget about international markets. They offer diversification and growth potential as well.
True. We can't ignore the rest of the world. What are some of the things to keep in mind when looking at international investments?
Well, one of the first things is currency risk. When you invest in a foreign company, you're also exposed to changes in the value of that country's currency.
So even if the company's doing well, your investment could lose value if the US dollar gets stronger.
That's right. You got to be aware of currency risk and factor it into your decisions. Another important thing to consider is political and economic stability. Some countries are just more stable than others, and it's important to invest in those with a good track record.
So it's not just about the company's financials. The political and economic climate matters too.
Exactly. You need to understand the risks and opportunities involved in investing investing in different countries. Some investors prefer developed markets because they're more stable, while others are comfortable with the higher growth potential but greater risks of emerging markets.
It's always about finding that balance between risk and reward.
Exactly. And that balance will be different for everyone, depending on their goals and risk tolerance. Do your research, diversify your portfolio, and make informed choices based on your own situation.
That's great advice. We've covered a lot today, exploring all these different options beyond the Magnificent Seven. What are some key takeaways for our listeners as they think about their own investment strategies?
I think the most important takeaway is that there's no one right way to invest. What works for one person might not work for another. Know your goals, your risk tolerance, and your investment time frame before making any decisions.
We can't just follow the crowd or chase trends.
Yeah.
We need to be thoughtful about our investments.
Absolutely. And you gotta be willing to put in the time and effort to do your research. There's no shortcut for careful analysis and informed decision making.
Well said. So as we wrap up our exploration beyond the Magnificent Seven, let's remember that there's a whole world of possibilities out there. Be open to exploring them and make smart choices that align with your individual goals and circumstances.
Exactly. And remember, investing is always changing. New opportunities pop up, markets shift, trends come and go. Stay informed, adapt to new information, and never stop learning.
Great advice. To our listeners out there, keep exploring, keep learning, and keep investing. The world of finance is vast and always evolving, but with the right knowledge and approach, you can navigate it with confidence and achieve your financial aspirations.
And remember, we're here to help you along the way. We'll keep providing insights, analysis, and different perspectives to help you make these informed investment decisions. So stay tuned and happy investing.
We've covered a lot of interesting ground today, haven't we? Exploring all these different investment options beyond those big tech companies everyone's talking about.
It really shows you how much is out there. There's always something new to learn about the market. It's not just about following the latest trends, but really understanding what drives growth and finding companies that are set up for success in the future.
Yeah, we've looked at everything from the S&P 493 to mid-caps, value stocks, and even international markets. It seems like there are opportunities everywhere if you just know where to find them.
And that's the key, right? It's about being informed, doing your homework, and making decisions that fit your own goals and risk tolerance. There's no secret formula for success in investing. It's all about having a solid strategy and sticking to it.
Speaking of strategy, what are some of the most important things investors should keep in mind when building their portfolios beyond those Magnificent Seven?
Well, diversification is crucial. We've talked about it throughout our conversation, but it's really important. Don't put all your eggs in one basket. Spread your investments across different asset classes, different sectors, different geographic regions. It helps manage risk and could even lead to better returns.
So don't just focus on the hot sectors. Build a balanced portfolio that can handle market ups and downs.
Exactly. And your investment strategy should change over time, too. As your financial goals and risk tolerance change, your portfolio needs to adapt. It's not a one-time thing. It's a dynamic process.
Kind of like taking care of a garden. You need to adjust and adapt to make sure everything keeps growing.
That's a great way to put it. And just like a gardener, you need to be patient. Investing is a long-term game. Don't get discouraged by those short-term market swings. Focus on the fundamentals, make good decisions, and stick to your plan.
That's a good reminder. It's easy to get caught up in all the market noise, but we need to keep our eyes on the long-term goal.
Absolutely. And remember, investing is a journey, not a destination. Enjoy learning about different companies, industries, and how markets work. The more you learn, the more confident you'll become in your decisions.
That's great advice. It's not just about making money, it's about personal growth too.
Exactly. Investing can be a powerful way to achieve your financial goals and build a secure future. But it's also a journey of self-discovery as you learn about all these different aspects of finance.
Well said. So to all our listeners out there, keep exploring, keep learning, and keep investing. The world of finance is huge and constantly changing, but with the right knowledge and approach, you can navigate it with confidence and reach your financial goals.
And remember, we're here to help you along the way. We'll continue to bring you insights, analysis, and different perspectives to help you make those informed investment decisions. So stay tuned and happy investing.
That's all for today's show. Thanks for joining us, and we'll see you next time.